On behalf of the Sustainability Reporting Standard Board of ICAI, I, Jyoti Singh, extend a warm welcome to all of you to the 28th edition session of our webinar series, Demystifying Sustainability, Catalyzing Growth. Today's session is centered around a critical theme, social and governance risk beyond E in ESG. We are honored to have with us our esteemed speaker, CA Krishna Prasad ji, and our moderator for today, CA Harshad Shahji and CA Kerul M. Gangar ji. Let us now begin. I would request uh, and invite CA Harsh ji to kindly take the session forward.
No. Thank you so much for the brief introduction. So, to proceed with, I'll brief you about our speaker, CA Krishna Prasad ji. So, he's a seasoned chartered accountant with over 17 years of experience in audit, assurance, and the advisory roles. He has worked with top global firms like EY, PwC, and Grant Thorntons, etc. Currently, as an executive director at EY Global Delivery Services, he leads a team of 1,000 professionals across the international market. He specializes in IFRS and the global audits. He excels in leadership, talent development, and diversity initiatives, driving transformations in assurance services. We hereby welcome you, sir, on the behalf of ICEI SRSBT. We may proceed. Warm welcome, sir.
Thank you, CA Harsh. I think such a good introduction. Just a quick update. Now I've elevated to a partner with EY GDS. So happy to share that with all of you.
Congratulations.
Thank you, thank you. A very good morning to all of you. I am really esteemed to be here. I'm fortunate enough to be invited by the Sustainability Board of ICAI to participate in this webinar as a speaker. And whatever limited knowledge I have in this field, I will try to share with all the audience here. And we will try to make this next couple of hours as effective as possible. So this session here, we are going to talk about ESG, and particularly we are going to go beyond the environmental focus to understand why the S and G pillars matter for business and professionals especially. So if I dwell into the agenda forward, we are going to do a quick recap of what ESG stands for, the rise of social risks. We will explore a bit about the governance risks, and then we will try to understand how these three elements, E, S, and G, are interconnected and why it is important to understand that interconnection as well. We will touch and how they overlap with each other and how much relevance that has in the current context, as well as our responsibilities as professionals, how we have to reflect on that. And then we will touch a bit of challenges in terms of measuring the various KPIs, today when we are talking about sustainability reporting, what challenges we are undergoing and how do we look at that in the current context. We'll little bit talk about a couple of examples on mitigating those risks, certain strategies, and what are the best practices to the extent we can take clue from the global practices, because everybody is learning in the current context. This is completely a new area for across the globe, both for organizations and also for professionals. So from there, we will touch about the role of professionals in this area. That's very important for all of us, especially chartered accountants. And then we will open up for Q&A. And I can assure you that we'll try to do justice to the questions. As I said, I'm also a learner in this whole process. And to the extent we can respond to the questions live here, we will do that. But at the same time, if there are questions that requires more discussions or reflections, I will love to come back to the audience, and you can reach out to me on my social media platform as well on the LinkedIn, and we can have conversations. Well, so with that agenda in front of us, let me get into the beginning of understanding what ESG stands for. I think it is not anymore a new terminology. We all have been talking about ESG for now quite some time. So, ESG certainly stands for the environmental, social, and governance. It's actually more than just a buzzword. It primarily integrates certain non financial factors into decision making, both in the finance as well as from a governance standpoint. And not only from a reporting or from an organization standpoint, I think these terminologies have had in place from a regulatory standpoint, though mandated recently, but then always government and regulators have spoken about that. I think if I recall my childhood days, anything related to environment, what I used to immediately remember is only pollution control board. We always, start with that. Right. So we have been talking about making cities green and et cetera, in every decades. If I look back 40 years back, right from my childhood days, pollution was the main problem at that point in time. Even now it is, but we have moved forward in terms of not just talking about pollution. But I would like to little bit narrate a bit of a story, here. Like some time ago, when I was talking a lot about ESG, I met up with one of the very young students, not chartered accountant student, school student, I can say, and uh, the student was trying to understand, not even I would say senior class, mid school student was asking me this question about, always there is this environment, social governance. What is this all about? So to make a student understand what ESG is, it was very, I felt it's a challenging question because audience matters, right? So I just gave an example of driving a car. If we are doing our pollution check and say we are now people are using electric cars. So does that mean we are complied with ESG? So I took that example and I said that, it's not just about the pollution control test and making sure that your car is under pollution control, and not that you use cars which are used run based on fuel, carbon fuel. Rather beyond that, S and G is about like whether are you following the traffic norms? Are you doing a no? Are you parking at a no parking zone? Are you overtaking? Are you speeding? Are you drinking and driving? So these are the factors which are beyond the environmental factors. So when the moment ethics come into play, I think S and G has more relevance than environment. See, environment many times becomes consequential aspect because we are setting up a business, because there is a manufacturing activity, because that requires a fossil fuel, hence there is a pollution. So which is consequential. But when we talk about social and governance, it has to be proactive. So that is where, when we have to talk about ESG in totality, always the relevance, right from our childhood days, our teachers have always told, do the right thing, you know, speak the truth. So it boils back to the ethics factor. So that is where, uh, ESG, when we talk about environment, social, and governance, it is no more a buzzword. It, of course, integrates the non financial factors into decision making, but it is very important to recognize the fact that in the current scenario, it's very, very crucial. So, moving on from here, if if we have to understand why it is beyond E, that is the S and G factors. Yes, S and G factors now matter more than ever. Beyond E is because social and governance issues are increasingly becoming material.
Krishna sir, so
Yes.
sorry to interrupt. You haven't shared your screen, so we are unable to see the PPT.
Not able to
For
see
it.
one second.
Yeah. Yeah. Now it is visible.
But is it in a screen mode
No.
now?
Not yet. Yeah. Now it is in the screen mode.
Thanks, KU, for calling that out. Sorry
Thank
for
you.
that. Right. So we are talking about social and governance and how that really matters beyond the environment factors. The reason is today the social and governance issues are increasingly becoming material. The stakeholders and from employees to investor are expecting today a holistic accountability and responsibility from the businesses and from the business units. And that is where it is important to understand that it's not just the financial performance that matters to our investors or stakeholders. It's beyond that. It's not just the responsibility of the businesses to provide returns to the investors. It's also in the whole process of earning and distributing the returns, the whole process needs to be done responsibly. That is where reputation, be it talent retention today, the service industry is all highly dependent on talent beyond the other sectors. And the operational efficiency, that's the first question today. Every investor asks that how much efficient you are when every rupee invested. And also when we are in a juncture where there are risks beyond our imagination. Nobody thought pandemic would hit. Nobody had a clue that geopolitical tensions would come back, right? We always thought, okay, with World War II, everything is become a peaceful world. But no. Since then, as the footprints of both economics and businesses have expanded and globe has shrinked into an open platform, I think competition and beyond that, securing each individual's interest is leading to various conflicts, right? And in the midst of all this, it's it is all the more important that there is to recognize the fact that there is a rising investor demand for a holistic risk assessment process. So that is where we will now deep dive into the S factor of ESG. When we talk about the spectrum of social responsibility, especially the S pillar, it is important to understand the social risks. To put it very simple, this includes how companies manage, say, relationships with the employees, suppliers, customers, and communities. It's important to understand the dynamics of each of these areas and how these are crucial for each stage of business in a life cycle of a business. This is something like, again, I will give the example of the car. A car has to be run, a business has to be run like a smooth car. These are like four wheels of the cars. Even if there is an issue, one derails, I think the whole machinery breaks down. So that level of importance and recognition is required when we talk about the social risks. We will go a little bit more detail into what social risk is all about and what are the core issues and maybe a couple of examples around that. So when we talk about the first social risk, human rights and labor practices are the foremost aspect. So from a first social risk category, there are issues like worker safety, payment of fair wages, and non-discrimination. When we talk about non-discrimination, that is where the inclusion comes in, right? If you if you have looked into the SEBI rules and regulations on various ESG reporting. I think on inclusion, there are detailed requirements, right? So, from that perspective, when we talk about non discrimination, when it comes to fair wages and non discriminative remunerations to labor class, it's all the more important. I think a lot of companies have now aligned and they are leading companies, I'm saying. They've done the assessment of gender parity when it comes to, say, be it wages, be it social security, compensation, or any kind of compensation, variable compensations paid to different class of the labor. It is very essential because any failures on this aspect these days lead to lawsuits, regulatory fines, and all the more reputational damage. Inclusion is not just about an option or a choice that organizations have to make. I think it has to also be looked into the from the ethics lenses. And that is where all this has a clear impact on the social risk factor. So if we have to talk about the next social risk factor is about supply chain ethics. It's not just about the labor, but beyond that, the entire supplier network. Some businesses and some owners of various businesses today who are not well aware of these concepts, when I meet them, there is always this lack of understanding that they look into within the organization. But that is where I keep calling out that it has to be looked beyond the organization. It's not just that, we are running a sustainable business if our house is in order. It is also about the neighborhood. It is also about the extended network with which the business is interacting with every day in, day out. So, what I'm trying to say here is the second major social risk, that is the supply chain ethics, goes beyond the company's four walls in ensuring suppliers are following ethical practices. Any lack of transparency can cause regulatory action, and also we have seen brand boycotts. We have seen withdrawal of products because of issues cropping up. But sometimes, they are also brushed up saying, okay, there is a technical challenge, but you never know. The root cause of that could be anything. And many times the root cause is also ethical issues or discontinuance of say, a particular supplier because of the ethical challenges. So it is critical to recognize these risks because these can cause supply chain disruptions leading to investor pressures. Today, there is definitely a lack of visibility in terms of sub-tier suppliers. So that is where it becomes all the more important to make a risk assessment framework which subsumes even the last person in the supplier network. So there are different tools for that and different methods for that. I'm not getting into there. It's a subject and it's a whole advisory in itself. So that was about the social aspects. Now, when we talk about the social risk, number three, the community impact and relations. That is, we spoke about the labor, we spoke about supplier network. Now, beyond that, the third factor is good neighbors. Community impact and relation definitely makes a big, it plays a big role in this whole ecosystem. Companies must manage their local footprint, whether through employment, pollution, or philanthropy. Losing a community's trust can always lead to protests or shutdowns. And these are not new things in the last few decades where we have seen that there are recurring instances. There is number of examples. If you are not able to manage your community and the impact the businesses are causing, you're always ending up in uh, different situations. And of course, there is always the risk of even the political system taking leverage of that, and the whole issue goes to a different tangent. I'm not getting in there, but then I'm just trying to flare up the potential exposure what companies face. There are several projects, I think, in India, within the Indian continent, subcontinent, we can see that, started with good intentions, but then if the whole impact to the community is not positive, or sometimes it is also to the narrative or the communication not really put up, it leads to shutdowns, and halfway through there are factories which have been projects which have been stalled. So that is where again the whole aspect of how are you identifying that risk at the first and foremost. So whether have you recognized that as a risk in your whole risk assessment framework, and whether you have looked into potential mitigation strategies as to how to minimize the risk, right? So that is where it's very, very important to take the whole community together and deeply analyze and understand and recognize the risks, not just hearing about the core issues or risks and then always trying to not or overlooking the factor that, okay, sometimes businesses feel that these factors are very far fetched, far stretched, not generally causes or manageable. So when they say manageable by may not be in a proper way, but those are the mistakes which businesses carry out. So that is where it becomes all the more important to prioritize these risks and build those community relations. And there are good best practices, best examples as well of large companies which have done that. If you look at the large industrial setups, energy companies, even mining companies, they've always thought about the impact. And of course, we do have regulations as well where the community impact needs to be considered. But from a standpoint, community risks and social risk standpoint, these needs to be factored way much ahead in the game. So now we would transition into the governance factor, the governance risk. So the governance pillar, when we talk about, this is arguably the most critical foundation of long-term value. What does governance do? Governance determines who makes the decisions, how the accountability is ensured, and the overall ethical culture of the organization. Poor governance is always the root cause of the E and S failures. G is a very, very epicenter of the whole game here. When the G derails, E and S can never stand by. G balances both E and S. That's how I see it. So it's the internal engine that drives a responsible behavior. We'll certainly focus on some of the structural and ethical components that define a good governance. So when we talk about the governance risk factor number one, what comes to everybody's mind obviously is board structure and effectiveness. See, the board is the ultimate oversight body, and the whole responsibility and accountability always falls on the board. So it's the structure that is paramount. So we need boards that are independent, not dominated by management, and possess a diverse mix of skills, not just financial, but also technological, strategic. And yes, in the current context, the board members have to be aware of, they must be aware of the ESG related factors. So today, lack of board diversity often leads to a group thinking. And that is where, when we do certain lectures on management studies, the blind spot aspect comes in. Always when we talk about the soft skills programs, when we talk about blind spots, the common example we can always take is the biased discussions by the board. So for chartered accountants, the effectiveness and independence of the audit committee are particularly critical. So ensuring rigorous financial and risk oversight. So I think we should not just look at it from a mandate standpoint, because of course we have laws which are mandating the board structures, etc. But beyond that, when we talk about the performance of the board, it's all the more important to see that, okay, board is diversified. Is it diversified just to tick the box? Or is it indeed diversified where the actual contributions are coming in? You know, not to quote any wrong examples, but I have encountered, entities where the diversity factor is met by the same management or the promoter group just to tick the box. But that is not the way it should be. So there are studies, where when we talk about women diversity as well, there are studies which have proven that the most high performing and efficient teams are the ones which are majority women driven. There are several scholars who have written in their books and they have proofs. They have done detailed surveys to prove that. So it is about how to make the process efficient, the whole ensuring the ultimate objective of the diversity what it matters and not just taking the box approach. So that is where our roles as chartered accountants, not just merely taking the box of compliance, but beyond that, is the results being delivered? Are the required diversity or talk about different viewpoints are produced, brought onto the table and just giving results? Now, dwelling into the next governance risk is the executive compensation. It is always the major flashpoint when we talk about governance risk. And the core issue here is about the alignment. We need to understand, does the CEO's pay structure incentivize a sustainable long-term value creation, or does it encourage short-term risky gains? So there is a very thin line gap there. That is where many times when professionals go wrong. If there are short-term goals, definitely the oversight board or even the independent assurance providers or even consulting, if you're advising your clients, it all the more becomes important to raise the red flag. Any short term gains and linking those gains to the compensation structure of CEOs definitely has a higher risk. And that is where we are increasingly seeing pressure to incorporate the ESG metrics in the compensation, like achieving certain safety targets or diversity goals into the bonus structures. See, fundamentally, when the compensation structure itself is flawed, it can certainly be a powerful driver of corporate scandals. We have seen in historical financial crises. There are a number of cases. I've just quoted few. If you go to the internet and you search, you will get the detailed case study. I'm not getting down more into the details of these stories, but definitely want to flag out and call out that the aspect which needs to be always carefully looked into is the whole idea and ideology behind the executive compensation. What is the linkage? What are the medium to long term goals? What are the purpose of the organization? How does that really is getting stitched into the layers of executive compensation structure? That is where our role as professionals come into the play. And I think the past examples or scandals are good enough for us to learn and then take the right path and advising the clients. The third governance risk factor is about the business ethics and anti corruption. I think it boils back to the golden word integrity. Integrity is non negotiable. Business ethics and a zero tolerance policy for corruption are fundamental governance requirements. Again, I think we are auditing and accounting professionals. We are aware of the internal controls, and we understand that lack of robust internal controls are definitely a proof or an evidence for a weak ethical culture that exposes the company to massive legal and financial risks, especially in our country today with increasing regulatory scrutiny. adherence to a strong, visible code of conduct, providing safe channels for whistleblowers are essentials. And this is where, again, it's not just about having a code of conduct, because, code of conduct can be drafted by anybody. We have good number of professionals today who can draft the code of conduct. But to what extent are those code of conduct being put in place? Not just merely by the management of a company, for example, but going beyond that, how is that being talked about on everyday business? How are the employees being made aware of these? I've seen many companies, when you join a company, take up a new employment, you undergo a new hire training, right? You sit in the induction training, code of conduct is flashed. It is runs into hundreds of pages, and then everybody is told that, okay, this is a mother document, this is the Bible or Gita, everyone has to follow, and that's it. There ends. But the moment they see 100 page or hundreds of pages of code of conduct document, will any human being be able to follow that or read through in totality? I don't think anyone would have ever done that in totality. So that is where the organization's processes and systems come into the play, right? I mean, these are fundamental things, but then it's all the more important that if the ethics and integrity has to be completely stitched into the culture of the organization, the whole implementation plan and the whole talking about the code of conduct comes into the play. It takes a foremost importance. And then building in that channels where whistleblowers or employees can view their vocal or voice their opinions flawlessly or freely becomes critical. So compliance is a cost of doing business, but lack of compliance is a non-negotiable and existential threat. It will always prevail. If we see compliance as tick in the box and see it as a cost, I think we have already opened the doors for a threat to creep into our house and erupt overnight. And that is what is happening today to many of the companies. Most of the issues, most of the big scandals or whatever you call reputational damage, criminal charges against companies, somewhere or other, integrity has been compromised. So that is where providing the importance to business ethics and anti-corruption becomes all the more one of the key governance risk factors. So these are not the new concepts. I think these are in existence for ages, but it's just that how the business and dynamics of businesses are becoming more and more challenging. Always there is this gray of, like, to what extent these should be given importance to. But that is where the more you try to do it is still less in the current context, I would say, in my own personal experience. So it's all the more important to just have these things set right and continuously practiced in the organizations. So what is the new elephant in the room when we talk about the governance risk? Cybersecurity and data privacy. I think this is, again, though technology related, we can say that recently in the last couple of decades have taken its importance. But then in the 21st century, the cyber risk is a top governance priority. It's no longer just an IT department problem, because this is where the fundamental mistake people do. Anything you hear about a data, cyber security, threat, risk, virus, antivirus, just say, oh, it's not my problem. IT will take care. There is a IT head. That is where we are paying to IT head. So these are common statements we hear. I mean, it looks very fundamental, but then that is the reality. I mean, it's a reality check. It is certainly not an IT department problem. It's a board level risk. So if you ask me if the board members have to have knowledge of information technology? Of course, yes. The boards must have that experience and knowledge. So that is where the other angle of diversity comes in. I'm just trying to knit it with the governance structure. The first factor which we talked about, the structure of the board. It is not enough to have a finance business person. It's beyond that. Yes, we must have specialists who understand, especially in the today's AI era. It's all the more critical and important. The board must understand the company's cyber posture and resilience plans. Data breaches are just routine nowadays. It's every day it happens. But how many are getting reported? Is the system, is the internal control system, are the processes robust enough in the company to capture each and every data breach, to report each and every single data breach? Inadvertent breaches, are the employees equipped enough and trained enough to report suo moto? It is important today. I don't know how many companies are really having that culture of suo moto reporting. There could be inadvertent data breaches. So that is where the whole cyber risk and mitigation plan and the whole data breach and privacy policy and implementation come into the play. Because today, from a GDPR standpoint, they carry huge fines under laws like Europe's GDPR or even India's upcoming DPDP Act. A governance failures occurs when the board fails to adequately invest in this and oversee the protection of corporate and customer data. Again, investment, they think that, okay, today a lot of companies want to leverage AI. They want to be on top most. But at the same time, it comes with the risk mitigation as well. AI is a big blessing to all of us, blessing to the businesses. They can be more efficient. They can cut down on a lot of costs. AI can generate a lot and lot of synergy today. I'm sure boards are happy, boards are ready to invest in that. But are the boards really ready to invest in overseeing and protecting the corporate as well as customer data? That is the question as professionals we will have to ask. The budgets don't allocate for that. It's a clear risk of operational shutdown, financial theft, whatever you call, and potential high risk of fines, and eventually even taking the business to a going concern threat. So, cybersecurity and data privacy risk is again, though it's the fourth risk, but one of the very critical risk from a business as well as the ecosystem standpoint. Now, having understood the social risks and the governance risks, it's time now. How do we analyze these and interrelate as to how each of these risks have an impact on each other, a cascading impact on each other? Because as professionals, it's important to recognize the fact that we should not err on looking at these factors as a silo aspects. I have seen many cases where each one is viewed as siloed. The moment they follow the compliance, take in the box approach, silo creeps in. But it's important to understand that there is interdependency and there is interrelation with each of this. One fails, the other also fails. Same like car example of four wheels. If there is a puncture in one tire, you can never drive the car right. So it is important to understand now the interdependency and interconnection of ESG nexus. How E and S are interrelated. A failure in one pillar often precipitates a crisis in another. Weak governance. I mentioned about that. I see always governance as the center portion. Governance often enables reckless pursuit of profits, leading to lax environmental controls. When profit becomes the priority, environment naturally takes the second backseat. Or unethical labor practices comes into the play. Short term gains. I think VW emission was one such example. A governance failure created the culture for environmental fraud. So it's not just about, having the fancy internal control metrics, risk assessment, and all that. But to what extent, in principle, we are as professionals and accountants auditing the soul of these risks and the mitigation strategies, and not just from one dimension, from multi-dimensional aspect. Many of the cases you take, definitely one failure would have led to the other to the other. It's not just one aspect. And that is where I always say that, be it environmental or social risk, governance is like a, soul of the whole problem. So how does these really impact? For the finance professionals, the most compelling argument today is the financial consequences. But S&G are not soft issues. They have a hard impact on the balance sheet. Reputational damage translates a major hit to the sales which the companies will lose. And again, legal non-compliance again results in massive fines, settlements. I think if you look into the financial newspapers across the globe, I'm pretty sure every day you will find one such report which will talk about one of these failures. I think it's a high time we raise and we kind of zoom out and see the big picture impact of all this and understand the poor social climate how leads to even staff turnovers today. So there are, I don't want to quote examples, but then in the even from the whole, uh, if I have to talk about the various attritions or layoffs which are happening, some companies, yes, they are compelled to do that, but sometimes it's not always linked to the efficiency or the AI factor. There are companies who are not doing great, so they are pushed to lay off or they are pushed to that decision making. But that's not again an overnight consequence. A failure in the past in terms of looking into these risks could also be a reason for today companies to not perform as it would have been otherwise, and leading to talent attrition or even massive layoffs. So it not just uh, you know a situation where they have to manage for that particular moment, but it also has long term impacts. But there could be potential root causes which could have led to these kind of layoff decisions. So when we talk about measurability, I think, of course, this poor social climate leads to staff turnover, which is a measurable expense. But investor, they are now pricing even the risks, in meaning a poor ESG profile increases the cost of capital. It is very important to understand that if the whole ESG profiling of a particular business is not up to mark, your cost of borrowing or cost of raising finance goes up. That is what we are seeing the change today. The importance being given to social and governance risks, linking it directly to access of capital, the potential possibility of businesses to raise capital at what cost. So therefore, there are multiple dimensions. We need to understand these dimensions that, it's not just a software aspect. It has a direct financial impact on the businesses. Now, how do we measure these challenges? If we have to talk about measuring these challenges, especially with respect to social and governance, this is where the rubber meets the road, I would say, for chartered accountants. So measuring the E factor is relatively straightforward. I'm sure, all of you must have gone through the metrics, have done audits, put in all the advices for your client, counted the carbons, performed physical verifications, It is easy, right, to measure the carbon factor or measure the liters of water wasted or generated. But we also recognize that S and G factors are more complex. See, the problem and the complexity is coming in as to how to standardize these metrics. How do you quantify an ethical culture? Is it possible to measure a community happiness? Today, we are trying to do something in terms of relying on certain proxy metrics, like the last time injury frequency rate, employee turnover. If there is a high employee turnover, that means the culture of the organization could be an issue. Employees are not happy with the policy, therefore there is a high turnover. Could also be a competition issue, right? It could be a reward issue, could be many reasons. But to what extent are the companies measuring that? I think some of the best examples, if I have to talk about companies follow, is also about uh, surveying people opinion within the organization on various factors. And then, for example, like, again, when we talk about attrition as an example, exit interviews, robust exit interviews, anonymous interviews, which clearly calls out reasons and how the employees view an organization's culture or policies. Those are fine interventions, right? Which clearly provide you opportunity to measure the softer aspects of social and governance metrics. Sometimes we also fall on the percentage of independent directors. But again, I will go back to my earlier point, which I said, like, it's not just about having number of independent directors. It's also about how diversified opinion you're getting. Out of those directors, how many of them come with varied niche expertise? What are they really bringing onto the table in terms of their experience and advice? How is the decision making getting challenged? How critical is the process of decision making? All these aspects are not easily measurable, but yes, today I think the whole challenge is about how do we standardize these metrics. I think the challenge is about moving from these proxies to meaningful auditable data. That is where I think, in my view, leveraging artificial intelligence data, organizations are sitting on huge data. If those data can be crunched and interpreted, analyzed in a very, very meaningful manner using the technology, I think a lot of metrics can be generated. A lot of ways and tools can be generated to measure the social and governance aspects, factors, and mitigate the challenge or address this challenge of measurement. That is where I think it's an opportunity for professionals like us. We have vast industry experience. We understand the economics. We understand the business concepts very well. We have exposure to various sectors and industries. Problems we have seen from a, say, financial reporting or business standpoint in the past. Using that knowledge and expertise, investing a bit of time in taking out these data or leveraging AI to or creating data lakes related to this, or even structuring these data, the past data, into various aspects which are relevant for creating those standardized metrics will definitely be a good value add for professionals to extend to your clients or even to within your organizations where if you are in the industry. Now from there, little bit I will try to touch upon existing frameworks. I think it is not new. We are all part of this journey when it comes to the SNG reporting frameworks. I think business responsibility and sustainability reporting, BRSR, the SEBI mandate for top companies that integrates the SNG metrics. I think I also heard many professionals globally talking about our BRSR report. I think this covers the 100% of the principles of sustainability reporting compared to other geographies within different markets globally. So India is in the forefront when it comes to these for metrics. We have adopted all the principles. one of the finest and topmost, I would say, that content what India has in terms of regulations. Other countries, I think, are following selectively basis their geographical priorities. So the landscape is definitely crowded. There are global standards. We have our own Indian standards. In India, the BRSR, as I said, is mandated by SEBI. Is a massive step which is forcing the listed companies, top companies, to report the specific metrics on social and governance. And globally, when organizations like JRI and SASBs provide these framework, as a financial professional, we must be conversant with our BRSR and also these global standards. They certainly very well dictate the how the data management needs to be done and how to collect and how it should be presented for assurance. So it's a vast area to understand, but definitely gives again the opportunity to not only equip ourselves but also provide that support and insight to our clientele, which is a great opportunity, I would say. So there are, I think, already courses and different other webinars which dwell deeper into these metrics. I am not covering that aspect as it's a whole day lecture altogether. But I would highly recommend to professionals who are maybe new to these areas to go and refer our institute's webinars in the past on these subjects that will help you understand these standards much more in detail. We also have the BRSR courses. Those who have not taken up, I would encourage them to take these courses. So from these framework to mitigating strategies for social risk. Now, mitigating the S risk, the social risk, definitely requires operational depth. It's not just about the philanthropy. It's about a fundamental systematic change. Because as I already mentioned, say we take the example of supply chain. Supply chain risk requires looking beyond your immediate suppliers. And again, when we talk about the data privacy, it requires a dedicated senior level owner to whom the responsibility is assigned and an oversight committee or a board beyond that or above that. And further, grievance mechanism implementation is very, very critical, not just for employees, but for communities affected by our operations. So always when we have talked about grievance mechanism, whistleblower, all that, the mind only talks about things about the internal to the organization. But the blind spot is beyond that. The blind spot is outside the organization. How much are we trying to get the understanding in our communities? How are our communities affected by our operations? How is the channel open enough for communities to voice their concerns without any fear or reprisal? That is where the needle movement should happen. That is where that fundamental systematic change that need to be brought into to mitigate the social risk factors. Now, moving to the governance risk mitigation. Now, annual board effectiveness review, mandatory director training on ESG, all these are, uh, examples. But then mitigating the governance risk means fundamentally formalizing the responsibility and accountability, especially. It's not just leaving it to the board. It is also that board needs to be constantly assessed for the effectiveness and skill gaps. I will again, harp on how is board getting assessed? Because today the failures, when we look back or when there are governance risk failures, it is boards that are being questioned. So the buck doesn't stop with the board. It of course it stops with the board in terms of, when it comes to that whole blaming process. But then what are organizations doing structurally to bring that oversight onto the board as well, to see that how effective is the board performance effectively measured? I think corporate governance does talk about that. But then how is the mechanism today robust enough? How are we going in depth? How are we understanding and mapping the skill gaps? So that is where assessment of the skill gap at the board level becomes very, very, very critical. Compensation structures must be reviewed annually, critically, benchmarked to ensure that they align with the stated ESG goals as well. Bringing in the ESG goals in the compensation structure is becoming all the more fundamental now. Again, existence of whistleblower, independent, trusted. So the whole narrative has to change. The companies have to make their narrative very open. That is where the trust factors come in, from communities, from the supplier network, customer network. Is there channels that are reachable? So good governance, that is when an organization can demonstrate, not just by having policies, but the rigor and independence with which they are enforced. Today, see, I understand there are sensitivities around when companies have to talk about their own internal failures. But then, say, within the organization, within the close groups, when there are employee meetings, say, when there are supplier meetings, it is always a good practice to even flash out saying that, hey, we had in the past, so these are supply chain challenges. These suppliers reached out, we mitigated this, we addressed these challenges, and openly inviting that kind of a narrative conversations have to happen, not just supplier meetings by negotiations and the business aspect. Talking about the governance and demonstrating, walking the talk is very, very important. Internal employee meetings in the town halls, how many of the companies are really demonstrating to the employees that there is a system, there is a process. These are the breaches, data breaches that has happened. These are the governance issues which are, without giving any precise examples, there is always that can be a wider communication, wider socialization of the processes, where they make the employees understand that yes, there is a process, there is a system, there is a reflection process. They can communicate the concerns, and so many have communicated. These are the after actions taken, and this is how the company is following the governance process. That makes the psychological safety factor, enhances the psychological safety factors of the employees, and elevates the company's position in terms of demonstrating that rigor and independence with which they are implementing governance. That is a systematic change, which is highly uh, desirable. There are companies which are doing, they are the best practices which I'm quoting, but there are still a lot of companies which have to look into these factors. Now, when we are talking about all these risks, all these mitigation factors and strategies, again, where is our role coming in as chartered accountants? As I already mentioned, I think the role of chartered accountants in the ESG risk is very, very critical. I think I would say that this is the important juncture, the most important, juncture where we are uniquely positioned to manage the S and G risks. We are now moving from auditing financial statements to providing assurance on non-financial data. And that is what is market is demanding today. See, we are the architects of internal controls. So when we talk about internal controls, we are working for the company, say we are advising on setting up the internal controls. Of course, financial reporting is one of our core strengths and we are focusing on that. But when assurance has to be provided today on non-financial factors, then just look at that. Financial financial reporting is one aspect of that. But the whole gamut, if you see, we must ensure that controls are in place, not just for the cash, but for tracking, say, employee safety, ethical sourcing, and board independence metrics. And as I said, as assurance providers or as assurance advisory providers, service providers, if we are able to leverage our experience, vast experience, I don't think beyond us there are any other experts in the whole country or globally when we talk about our profession. We are much well positioned to take that first step and build our expertise in this area, leverage AI as well. I think that's a big blessing for all of us, data and AI, and try to, architect the whole ESG risk control frameworks for our clients, look into the details of the metrics, the sourcing, go into the softer aspects of ethical sourcing, create the board independence metrics. Because today, our expertise in objectivity, due diligence, and risk assessment is indispensable. So it's a great opportunity. And these are certain, door openers for us when we are talking about expanding our horizons to even meeting, or serving global clients today. So from that perspective, what are certain fundamental, basic, practical steps, maybe to even emerging chartered accountants, emerging students, and newly chartered accountants? I would say that learn the BRSR. So what can we do? First and foremost is master the BRSR. It's the domestic gold standard, I would say. Second, when conducting internal or external audit, we must explicitly include the social and governance factor in our risk scoping. Advise your clients to stop treating non-financial data as like, afterthought. We can manage, बाद में देखा जाएगा. That attitude should be discouraged. We need to make the client, the audience understand that, SNG factors are the more challenging, and those are the factors which are leading to major. So when if you even call out three or four examples in the past of failures, I think that will be good enough evidence to explain to our clients that, why SNG factors is important while scoping the risk, and why they should prioritize the non-financial data reporting. And it actually needs the same rigor and control as financial data. So our future lies in extending our assurance umbrella to these complex but critical non-financial risk. Right? So we need to, first of all, master the BRSR, integrate the ESG into risk audits, SNG factors especially. We have great opportunity to advise the data on data management, help the clients to building in the robust systems, and focus on materiality. Basically, to determine how the social and governance risks are financially material to the business. So today we can talk theory, but it is also important to demonstrate to our clients that how these failures in the past have impacted not just picking up the fines and penalties what they are talking about, how the businesses have derailed, how the whole business has lost the future pipeline of expansion, or completely say shutdowns a particular line of business. Those are all the major impact, how businesses have shut down their different products, withdrawn from the markets. Those are the kind of examples we should talk about. Evaluate that financial impact and reflect on that, articulate that. I think that is what will make our clients understand why SNG factors are critical, important, and why efforts and energy must be channelized towards those. So moving from here, how the future trends look like in terms of evolution of social and governance risk, I would say that the SNG landscape is consistently, rapidly evolving every day. We are definitely moving towards a mandatory assurance globally. I think one good thing for us as professionals in India, we don't have anything like an omnibus, which was a challenge for global professionals. But from an Indian context, I think we are intact, and which is a huge opportunity for CAs. The social focus will shift to complex topics like ensuring a just transition, making sure the shift to renewable energy doesn't negatively impact the workers and community. It's an example. Governance will increasingly address the ethical use of emerging technologies. I think responsible AI is something which is definitely taking the forefront today. So it's not just companies leveraging AI. it is also about responsible AI. And if I have to quote an example of, whether AI is a risk or not, I was attending one of the AI seminars, and one of the eye-opening aspect was that if we are today, say, talking, and I am talking from a financial, say, assurance standpoint, when we are talking to our clients and assessing the risk from a AI, if the client says that no, we are not that equipped enough, we are not that advanced enough to adopt AI, so AI is not a risk for us. You know what the uh, professional was telling to the audience, that that itself is a risk. Basically, if if the company is unaware of AI, because it's not an option today. AI is not an option. It is just creeped into our drawing rooms and kitchens, dining rooms and bedrooms everywhere today. AI. So if a company thinks that, shutting their eyes, we don't want to adopt AI, that thought process itself is the risk, because somewhere inherently AI has got integrated into the business. It's not just the company. If they are buying from suppliers who are, say, the entire supply chain is AI driven, you need to evaluate that, right? How will that, if any failure from a supplier standpoint, will derail the business risk? So it's not just about AI is not a tool or it's not a technology or a new computer. It has become like a wave. And a company saying that we don't want AI itself is a risk. So that is where the awareness has to be looked beyond and broadly. And we as professionals, especially, have to recognize the factors that we have to stay ahead of this curve. It's very, very crucial. So, again, responsible AI is another very, very important area of specialization. There are a lot of governance and policy making there. It interfaces directly with the financial reporting system and entire financial control system as well. So even that is another area of expertise and opportunity, which again has an impact on governance and social risks. So the future trends are very clear. If not today, in some part of geographies of the world, definitely globally, I think it's only going to expand, and eventually we all will get there where it will be like a bread and butter and daily soap for us to consume. So we have to be prepared for the regulatory convergence. And again, like, when we talk about the ESG, SNG has to be looked as elevated layer of the whole fabric of ESG, and technology will always be the outer crust of the whole thing. So nothing can escape the technology factor. So that is what largely on the governance and social and governance risk factors. So if we have to little bit sum up in terms of key takeaways, I think beyond the social and governance failures pose immediate existential and measurable financial risk. It is very, very important to understand this. Social and governance risk are not secondary. That's very, very critical. They are primary financial risk that determine a company's long-term viability. So, needless to say, effective governance is the foundational layer. And as ICI members, we have a mandate to step into this space, applying our skills in control, risk, and assurance. Because end of the day, we are the ones who have to build that trust and integrity in the non-financial reporting of the future. Otherwise, I don't think regulators will be choosing us to provide that assurance. So therefore, it becomes the all the most uh, fundamental, responsibility for us as assurance providers, as professionals. So the market is demanding it. So we need to unlock this opportunity, potential, equip ourselves, upskill ourselves. If we have to upscale in this whole gamut, I think we need to upskill. And as a professional, we must deliver on this. And great opportunity to emerge as the global, professionals in this area. As I already called out, I think ICAI or the BRSR principles have taken into account 100% of the principles of ESG, unlike other countries where they have picked and chosen what is relevant. So it's a great opportunity for us. So with that, I think the whole presentation is kind of now coming to an end. Maybe this is a time we can open up for some questions or some kind of reflections if any of you have regarding this. You can also share, your thought process or examples if someone wants to talk about. Harsh or Keyur, are there any questions from the audience?
Yes, there are few questions. There are a few questions. We'll take one by one. First question is, why do you think the S and G pillars are often overshadowed by E in ESG discussions?
Yeah, no, I think so. If I just it's a good question. Of course, it's a very fundamental question to the whole discussion. So that is the current problem statement today. What is happening is that we are conventionally aligned and in prioritizing the environmental factors. And the way the conventional narratives were set, the prioritization and weightage was given and mostly talked about. See, because it's not just an area or a subject matter for professionals, it is a common public subject matter. So, from that perspective, the way the general public talk about or we have heard most. So what we hear the most, always we believe, right? So that is where we are used to always hearing about the environmental factors, but the governance and the social aspect is less spoken about. The narrative is more about environmental, but the narrative is also does not call out or highlight how these environmental, even if we take the environmental factor, how does that also has an impact on the social and governance factor, or how the governance failure was a root cause for the environmental factor is not talked about, or it is not discussed enough. So that has been one of the root causes of SNG always taking a back seat. So that is where, as professionals, it is our responsibility to give a holistic view and talk about that. Call out that, okay, suppose there was a factory which is set up. I'm just taking basic examples here for everybody's understanding. That is today emitting the yeah, pollution, which is easily an easy example for everyone to understand. But the governance factor failed on the day one when the whole business plan was made. So where is the governance then? Why did the governance not take into account the environmental impact? So that is where sustainable business practice, when we talk about it, further boils back to ethics and integrity. Do I really need to do a business which is creating an impact on community? See, as a civilization, when we evolved, when we got overwhelmed with exploiting the natural resources, we just went cutting the trees, which is also what we are doing today. Today, if you take the fundamental, in my own locality, when we are talking about flooding because of rains, that's a different story. That today houses are getting constructed in the lakes, but then end of the day, water is coming in and you are creating a drains, But then to create that stormwater drains, again we are cutting the trees. So we are always going back into the loop, but somewhere we are not going and challenging the root cause. We are not challenging the structure, so the structural changes that need to be brought in are not today getting challenged. And that is the fundamental reason that it is not being talked about. There are multiple reasons. I don't want to go into that. There are multiple factors, both, business as well as institutional, organizational, political, whatever you call. But that is fundamentally the reason that we are not discussing enough about SNG factors. And I hope that answers broadly.
Okay. One more. How can companies practically monitor labor practices and human rights in deep trial supply chains?
Sorry, can you repeat that
How,
question?
yeah, how can companies practically monitor labor practices and human rights in deep trial supply chains?
Okay, so I think human rights and the other part is two different aspects. Okay, labor part is so we, I think in our presentation, in the discussion, we talked about metrics, right? So today, yes, I do agree that these software aspects are not standardized, but there are benchmarks and practical formats and frameworks available. So that is where analyzing the data is very, very important, and collecting the data of bringing into the fold of your supply chain monitoring, your ESG policy, the suppliers whom you deal with, and the suppliers whom they deal with. Going up to the last mile is the first step forward. So bringing the whole network into the gamut and fold of your ESG framework is very, very important. Step number one. And then collecting the right data, having the right conversation, all those submissions from that perspective, getting access to all those irregular information on a periodic basis, and then framing your metrics. I'm not going into precise examples because it depends on business to business, but there are examples publicly available. But I definitely don't encourage people to just adopt what is available, because a particular framework available for a particular business may not apply to the other business. So it's very important to invest and innovate into your own domain. But fundamentally, it is important to open that channel of communication and lines and collection of that data, having conversations, bringing in those steps into your customer or vendor selection process. It becomes critical there. So these are certain basic processes which needs to be in place. Then you will be able to devise your own metrics to monitor that. That's where I would highly recommend teams or people to uh, leverage data and AI in this area.
Uh, what role can chartered accountants play in identifying red flags in social risk area like community impact or employee welfare?
Yeah, I think it goes back to my point of like how much we are able to analyze and understand the oversight over the board. It starts from there, and how the companies are making their vision, 100 billion vision, 100 million vision, but all profit vision or turnover visions, right? So, what is the fundamental objective behind that? Is it just creating that shareholder wealth? But what are the timelines? Overnight, 3 years, they want to achieve 30x. There are companies, there are solid examples where fundamentally businesses have kind of shattered and broken and come to soil which had such ambitious plans. But then obviously those ambitions plan is the first trigger to the risk. When there are ambitious plans, it is important to understand the objective behind those plans. What is that the company wants to achieve behind by achieving those numbers, and how are they putting the roadmap to achieve those plans? And in those roadmap, how much weightage has been given to these factors? That is what we as independent professionals today are in a position to challenge and question, right? So different dimensions of that particular business plan is something which we need to look at. I'm just giving an example there. A new product launch or a particular line of business, they're expanding, say, uh, rigorously, accelerated way, the risk triggers there. So from there, it should be assessed and then looked into in detail to understand what could be the potential governance issues there, what could be the potential social and community impact being created, and is the right talent available. Then to that extent, if the right talent is not available, what kind of talent are they going to do? How are they going to manage that? So there could be multiple questions. So this is what is important as, and that is one of the reasons we are expert in that, is like questioning. We need to ask those questions and identify those risks.
Okay. On interconnectedness of ESG, could you share
Sorry,
a
Kayur, can you repeat? You're not audible.
yeah now?
Uh, can you be a little more louder?
Yeah, now can you audible?
Yes.
On interconnectedness of ESG, could you share a real world example where poor governance amplified both environmental and social risk?
Yeah, I think we talked about issues like Volkswagen case was one, and then when Wells Fargo case, where uh, social risk is also, if a governance failure. I will take a simple example. A governance failure leads to the breakdown of the whole business, especially more the businesses are large. If you talked about large conglomerates, look at the employee base itself. If the employee base is running into thousands and lakhs, a governance failure, bringing the shutters down overnight could impact so many employees. So that itself is a basic example of how a governance risk impact has a financial impact on the company. The company shuts down, and then look at the employees, what happens to them, their families, and their community dependencies. Fundamental example. So it's actually part of, it's like a vicious cycle, I would say. One has obvious interrelation to other. And majority of the cases when there is an environment issue or when there is a social issue, somewhere the root cause question backs to the governance. What did the management do? Why did the management not consider? That is where it boils back to. Yeah, there could be, see, whether management did it intentionally, unintentionally is a different question. But that is where it's not just about the governance being ticking the box. It's also about how governance is equipped enough. How is the board of directors knowledgeable enough? How diversified their skill sets are? How are they able to bring that different dynamics onto the table, understand the risks, and then accordingly take decisions on businesses? That is where we as assurance providers have to question them. You can question the fundamental structure of itself about the board. That why, if there is a need for an expert from a community side or from a environmental side in the board, there needs to be one. It just can't be like, okay, I have an ESG officer appointed, he will take care of it. No. If that is the attitude, then there is a governance issue. The board structure is weak. The way they are calling shots are weak. It should be red flagged. I hope that clarifies.
Executive compensation always be linked to ESG metrics? If yes, what kind of SNG metrics are most relevant?
Okay, you sorry, not able to hear you.
Should executive compensation always be linked to ESG metrics? If yes, what kind of SNG metrics are most relevant?
So one is, so the way I think the BRSR is framed, there is a metrics already, and if we talk from a overall governance standpoint, the question is not about whether it should be only linked to ESG metrics. It should also be linked to ESG metrics. Financial obviously shareholder wealth creation and investor returns is one of the key objectives of business. But along with that, equally, ESG metrics should also be linked, because the money which is being generated as profits, as wealth creation, should be sustainable. It should be a clean money, if I have to talk about. And when I say clean, don't misunderstand the word. It's about like as a wealth created, which is created through sustainable practices. So that is the first aspect of your question. Now, the second aspect, like how do we really link to? I think we did discuss about certain factors. Let me just refer back a second. Executive compensation, when we talked about safety targets. So if it is a highly labor intensive, if the product which is being manufactured undergoes a very rigorous manufacturing process, where on the say on the shop floor, so reducing the number of accidents on the floor, that is one such example, right? Similarly, if there is a water contamination that is happening, linking it to what is the, so company may have what mitigation factors, like how the water contamination is purified and let out in the neighboring hood, but there could still be certain indirect impact. So how many number of say uh, sickness cases are reported in that vicinity of that business? So to how many people is it really impacting? See, those are certain things which is just beyond. So that is where that extended network comes in. So if those are certain number of metrics which can be linked, then the rigor with which the whole system will be taken care is very different. So there are a number of examples you can quote. Diversity goals. So as I said, it's not just about the women employees in the organization. It's also about what is the uh, dynamics of that. So today, when we talk about diversity, young generation, how many are you? Social equity could be one factor. How many employment you are providing to students who are coming from a non-tier one cities? So that could be one metrics. So there could be a good metrics where you are addressing certain community and social factors challenges, which could remunerate the board structure. So it can be picked and chosen depending on the relevance to them and how much impact is it really going to create. So that is where again we talked about how, when we talk about how financially material it is also about like what are those S and G factors which has a potential impact financially on the company, both positive and negative, and then accordingly pick the metrics which can be linked to compensation structure.
From your experience, which mitigation strategy for social risk have proven most effective in Indian context?
Super. So it's a wonderful question. I come from a service sector where talent and employees are the major base. So definitely, I would say that certain measures like employee satisfaction rate. So today, see, when we talk about diversity of both generational as well as employees data. So if you take any organization today, which is say in existence for more than 50 years, you will definitely see minimum 3 to 4 generation employees working in that organization. So from that perspective, in my experience, giving importance to employee satisfaction rate and not just sending, a survey of say 3 questions. A survey of say 30 or 40 or even 60 or sometimes 90 questions to employees on different areas of where the organization is functioning, and taking that employee survey and how that is impacting both in terms of, so some examples are like is open questions like is the employee satisfied with the compensation, is the employee thinks that they are good enough recognition of their efforts, does the employees have good well-being measures taken by the organization, are they overworked? So these are certain questions, and these are certain structures which tools which really helps bring that impact from an employee standpoint. So that has proven really well, because today in service sector, when talent is niche, when talent is the demand, in many, we may say that okay, India is 1.3 billion population, but sometimes certain businesses where we are into certain niche expertise where we need, still we find talent shortages. At least it's a timing factor. When the timing when you need the talent, you may not be available. So retention of talent becomes a primary factor. So from that, addressing that challenge, it is easier to go this route and bring in a sustainable policy practice in place, because talent attrition is also a major risk to the business, right? So that is an area where I have seen that it's in my experience, it's proven very well.
Will AI and technology reshape governance and social risk management in the next decade?
If I correctly understand the question, impact of AI on the social and governance in the next decade? Yes, of course. I mean, no, next decade. Already we are into that era where AI has started impacting. The moment AI starts impacting the businesses, your social and governance factor automatically subsumes into that entire value chain. So there is no question of still thinking that whether AI will impact or not. It is already into the game. So that is the reason I precisely spoken about that why as professionals we have to upscale our whole future growth. It is important we look into the impact of AI on our clients, and especially when it comes to social and governance. That is where I see this as an opportunity for us. So before even looking into the problem statement, it is good to see this as an opportunity and be the first shop provider, service provider to our clients with those client insights which can be taken through leverage. So when you are leveraging data and AI, your reliability goes up, your trust factor goes up. The client insights what you can provide are more precise and accurate when compared to generic statistical or just taking some random approach.
Okay. How do framework like BRSR, GRI, and SASB differ in addressing SNG disclosure, and what role can assurance by CA play in the building investor confidence in non-financial disclosures?
Two things here. Good question. You need to understand what is the requirement of the regulatory framework of your client. If they are regulated by the Indian stock exchange, your BRSR comes into the play. GRI and other guidelines are applicable if the client has footprints there, and if their regulations also invite disclosures or mandates disclosures under those standards, then you have to learn those standards as well. But as a again, from a client value addition standpoint, I would strongly recommend to at least go through those standards as well. Even I think other accounting professional bodies like ACCAs also have come up with some short courses and materials about the global standards. Understand that yes, they are different. If there is a fundamental difference I need to call out, I already called it out that we are following all the 19 principles under the BRSR mandate, but whereas other GRI and other standards are having different, I mean, amongst 19 they have picked and chosen basis the geographical needs. And then there are assurance standards as well, which have come out, which are only going to help us provide better services to our client. So if you are an ESG professional or you intend to be on the long run an ESG professional, nothing stops us from going into details of all these reporting standards and understanding their objectives, understanding the content. And it definitely helps us in also providing, when we talk about our BRSR standards, we can leverage from other standards, and we can actually leverage from the global companies. How are they reporting? Certain companies globally might be having some best practices. So there is nothing wrong in taking those examples and using them. Yeah.
Do you think Indian companies are adequately addressing supply chain ethics, especially in light of fair trade issues?
Sorry, Kayur, you have to repeat. It's not
Do
louder.
you do you think Indian companies are adequately addressing supply chain ethics, especially in light of fair trade issues?
In light of
Fair trade issues.
fair trade
Trading.
issues.
Yeah.
No, I think one aspect I must say that the moment, see, that is what we have always seen, not just Indian companies, globally, anything until and unless it is mandated, importance doesn't come in. But there are also companies where I have seen in the past, because ESG is the new terminology now, but responsibility, I mean, sustainability reporting in some or other form, there were companies which were doing, and even our Schedule 6 in the past had those quantitative, when we used to do articles, we used to report on that last 2, 3 pages of notes to accounts, and we always used to think that, why are these disclosures relevant? But today's context, so from an Indian standpoint, we always had that. But how did the users really look into that has come into the forefront now. So now, since the investors and the finance providers have giving the highest, most importance to these factors, that is where the mandating has come in, and Indian companies have really started looking into that. So, from a fair trade practices standpoint, I think we are going in a right direction, and the kind of standards we have brought out, the kind of disclosures we are talking about, I think it's definitely world class. I must say that. And as I said, since it addresses all the 19 principles, I think we are topping the chart in terms of the direction in which we are going. And obviously, the top companies, when they are where they are mandated, yes, they are largely following. But there are also companies where they do not have the basic data or the processes in place. I have seen their sustainability reports where they have not been able to report those. Okay, so it's not that everybody is 100% able to do that. I wouldn't quote it as intentional non-reporting, but it is more circumstantial and structural changes where that is where we have the opportunity. So if you go and go through at least top 20, 30 companies or even 100 companies you take, go through their reports, you will find differences. You will find areas where some are not able to report. Now, those are the opportunities for us for ensuring fair trade practices and transparency in reporting. We can add value to those companies by coming up with tools and matrices or best practices, say from global standards or global practices.
What practical governance reform can companies adopt to prevent ethical failures or frauds?
Very, very, beautiful question. I love this. It all starts with ethics at home, right? So, see, when we talk about ethical fraud, it is all intentional. See, intentional is something, you can't, again, I think I mentioned somewhere, it's not about the philanthropy part of it. It's about like, uh, businesses have to realize that, end of the day, if you have to have a sustainable stay put in the long run, if you're in the game for a long run, or I think companies won't be resorting to unethical practices. So that is where, as professionals, we have to be questioning openly everything. It could be like unintentional or anything, but then we should be bold enough as professionals. Our institute gives us that right, and they equip us with all the standards where we have every tool to question the board and raise up and raise the red flag. See, because it's a purely a very judgmental to answer, whether we can really 100% curb or not, because it's not just India. Globally, this is a problem, and the kind of geopolitical situation we are into, everywhere the personal interest is involved somewhere or other. So one person or one institution or a framework cannot curb it still. But as professionals, if we do our job properly, if we raise right questions at the right point in time, I think we can be the torchbearer there, and we can certainly take businesses into the right direction.
Can you share example of how weak governance can lead to environmental and social failures?
I think we have answered this question already, right? Yeah. Yeah.
Thank you for taking all the questions. Yes. Now I request Harsha to give vote of thanks.
Yeah, thank you so much, Keyur. Before we start with the vote of thanks, I know each and every participant would acknowledge the way Krishna sir has elaborated the topic with so much of anecdotes. His experience was all the way throughout the whole seminar. I personally enjoyed each and every part of the seminar, and even the Q&A part. Questions were too good by the participants, and the answers were even brilliant. So now I proceed to formally vote Krishna sir for the session. So on behalf of Sustainability Reporting Standard Board of I extend my sincere gratitude to each of you for joining us today for enlightening webinar on social and governance risk beyond E in ESG. Your participation has been instrumental in making today's seminar a success. Not mistaking the heartfelt thanks to our esteemed speaker, C.A. Krishnan Prasad sir, for sharing his deep expertise and perspectives on social and governance risk, which is beyond E in ESG. His presentation has shed light on often overlooked dimensions of ESG, that is S and the G, the social and the governance part, that helped us understand how social risk, such as labor practices, supply chain ethics, community impact, along with government issues like board effectiveness, executive pay, which directly influence the business resilience and financial performances. The discussion this afternoon suggested insightful perspectives by way you connected this risk with a real world example, as I highlighted. You reported challenges and mitigation strategies as well. Importantly, your emphasis on the role of chartered accountants in strengthening ESG reporting, assurance, and governance framework is both inspiring and motivating for all professionals in our field. So, thank you so much, sir, for that. Special thanks to our participants whose engagement and thoughtful question enriched today's section, truly turning this into a collaborative learning experience. We invite all the participants to join our upcoming webinars, which is scheduled every Thursday, 4 p.m. to 6 p.m., where we will continue exploring crucial topics in sustainability reporting and best practices. Your dedication to advancing sustainability practices is invaluable, and we look forward to your continued involvement in our ongoing initiatives as we collectively pave the way towards a more sustainable and resilient futures. So, with this, I vote a thank to Sir and all the participants. Of course, this is a live session, so of course we cannot applaud Krishna Sir. However, the way he is elaborated, it is a very kind webinar for understanding the concepts. So thank you so much, Krishna Sir. And I'll also thank all the participants who have attended this webinar. Okay. So shall we call off, sir? Any comment from your sir to our new generations? Any insights for us?
Certainly, I think first of all, I would like to thank the Institute for giving this opportunity, SRSB team, and Harsh and Kayur being the wonderful host for today. And I think the only aspect I can provide as a piece of advice is continuous upskilling is what is going to keep us heart flag high. And engaging in these kind of discussions and these kind of forums, bringing together the knowledge and different perspective, because today we are, as new generations, are all in the risk of gluing to our own screens and our own social media groups. Of course, social media is the great tool for exchange of knowledge and information, but blending that with personal emotions and experience, sharing those experiences real life. Of course, webinar is the most effective, but if there are in-person events in the institute or in any of the leading industry forums, I would encourage our students, our members to participate and invest in upskilling yourself and meet those professionals, do wonderful networking with people. I think that is what will define our future roadmap to making this whole profession successful and contributing to the enriching goals of the institute. So that's where that is what I would call out for the new generation and my piece of advice. Thank you so much.
Yeah, thank you, sir. Thank you so much. Greatly insightful for us. Now I'll request the tech support and I say New Delhi to call up this meeting. Tech support. Yeah. Yes.
Thank you.
Thank you all the participants. Thank you. We meet soon. Thank you, sir. Thank you.
Thank you.